Autonomix Medical Inc., or Amex, is trading right now at $1.13, marking an astounding intraday gain of 55.43% in heavy trading volume. Now, the common expectation when you see a microcap biotech stock, and Automedical is definitely a microcap, with a market capitalization hovering just above the $5 million mark before today's surge jumped by this much, is that a headline-grabbing, definitive Phase 3 trial result has dropped. Everyone immediately thinks of binary outcomes: approved or failed. The reality, however, is far more nuanced, and this unexpected surge is actually driven by a deeper, less obvious catalyst: a post-hoc subgroup analysis from a previous, small-scale proof-of-concept study. That's a mouthful, but here's the key takeaway. It wasn't a brand-new final-stage success, but rather a granular look back at existing data that has suddenly amplified the drug candidate's perceived value in the market, particularly regarding quality-of-life improvements for pancreatic cancer patients, even those in late-stage 4 with metastatic disease. This subtle shift, from focusing merely on pain reduction to showing clinically meaningful quality-of-life gains, which is a much broader and more patient-centric measure, is the real reason the stock is taking flight today, and it forces a complete reevaluation of the company's technology platform. The prevailing market belief about a stock like Autonomix, which has been hovering near its 52-week lows in the $0.70 to $0.80 range, is that it's a high-risk, speculative asset in the pre-commercial medical device space, dependent entirely on future high-cost clinical success. The stock was essentially priced for failure, or at best, a prolonged, uncertain development path. What challenges this expectation today is the level of detail in the announced subgroup analysis. Specifically, the data uses the EOTRC QLQ30 scale, a validated industry standard measure for cancer-specific quality of life. The company reported that in responding patients, the average symptom scores improved by over 26 points at the 3-month mark, and more importantly, functionality scores also saw a large increase. Both figures exceeded the 10-point threshold generally considered to be a clinically meaningful change by the EOTRC. The fact that the late-stage metastatic subgroup, patients with the most severe pain who have few remaining options, showed substantial improvements further fuels the excitement. This isn't just about reducing a pain score, it's about enabling a dying patient to live their remaining months with less suffering and better functionality, which translates into an incredibly powerful commercial and clinical narrative. This is the difference between a minor clinical finding and a truly impactful therapeutic concept. And the massive volume spike today, which is many multiples of its average daily volume of a few 100,000 shares, reflects institutional and retail investors quickly repricing this potential impact. Looking closely at the recent stock movement, the sheer momentum is undeniable. This single piece of news completely obliterated the stock's recent downtrend, which had seen it decline from a 52-week high around $14.06. This stock has been a roller coaster, typical of microcap biotechs. But the sustained trading above $1 today is critical for 2 reasons: avoiding delisting risk, and, more practically for the market, making it visible to a wider range of algorithms and institutional screens that often exclude sub-dollar stocks. The trading floor buzz around this stock is not about a financial report. It's about a medical breakthrough's potential. Investors are quickly recognizing that if this nerve-targeted ablation therapy for severe pancreatic cancer pain can truly deliver such quality-of-life improvements, it positions Autonomix's core technology as a platform that could be expanded far beyond its initial application. This is a classic platform value story suddenly validated by compelling clinical numbers. It's not just a pancreatic cancer pain treatment, it's a precision instrument for treating conditions driven by dysfunctional or overactive nerves. This is why you see a flurry of activity, likely from high-frequency trading firms and smaller specialized healthcare funds who are comfortable with the high-risk, high-reward nature of this space. When we consider the broader business model of Autonomics, we understand the long-term play. The company is developing a first-in-class catheter-based microchip sensing array designed for nerve-targeted treatments. This technology can, theoretically, both detect and differentiate neural signals with extremely high sensitivity, and then precisely ablate or destroy the problematic nerves in a minimally invasive transvascular procedure. The lead indication is severe pancreatic cancer pain, which is debilitating and currently managed primarily with systemic opioids or blind, highly invasive nerve blocks that often have limited and temporary effect. Autonomics aims to provide a reliable, less invasive alternative. The core value of the technology lies in the platform, a precision instrument that can be steered via the vasculature to any part of the body to target specific nerves. If the pancreatic cancer pain application succeeds, the company has explicitly stated the technology can be extended to dozens of other indications, including hypertension, other chronic pain syndromes, and various organ-specific dysfunctions involving nerve signaling. This massive, latent market potential is what the stock is being bought on today. Back in mid-2025, they began a follow-on market expansion study, POC2, to extend the platform's scope to other visceral cancers like liver and bile duct, which further confirms their strategy of building a multi-indication platform. This past work, including the initial POC1 trial that provided the data for today's announcement, was the necessary groundwork. Today's news is the validation of that groundwork. It's worth pausing to consider how an investor manages this kind of volatility and speculative interest. For a self-directed investor using platforms like Fidelity or Interactive Brokers, a stock like Amex is clearly in the speculative portion of the portfolio. It is certainly not the kind of asset you would find in a typical Schwab Intelligent Portfolios allocation, which focuses on broad diversification through ETFs and mutual funds. You wouldn't find it alongside the stability of Apple stock or the established dominance of Nvidia stock. This is where online investment and self-investing demands detailed research. The institutional ownership is small, reported at around 4 to 5%, but you see names like Mariner and Susquehanna International Group holding small positions, which is typical for funds that specialize in high-volatility, event-driven assets. The key for anyone looking at this surge is to understand that the volume is real. The news is real, but the price stability moving forward is far from guaranteed. The future outlook for Autonomics hinges on two things: successfully navigating the next phases of clinical development and maintaining a healthy financial position to fund that process. The company has indicated that the insights from this subgroup analysis will guide their upcoming U.S.-based multi-center clinical study, which is currently planned to begin in 2026. That timeline and the successful execution of that trial will be the next major catalyst, or potentially a major headwind. The tension remains high between the expectation, now fueled by today's spectacular move, and the reality of a long, costly regulatory road ahead. The risk is dilution. Microcap companies often use these stock surges as opportunities to raise capital, which dilutes the shares and can pressure the price downward even if the news is good. This is a common pattern in biotech finance. However, the opportunity is the potential for a high-value partnership or an acquisition by a larger medical device player who wants to snap up this promising platform technology before it gains pivotal trial success. The strong buy consensus from the single or two analysts who cover the stock, with price targets ranging up to $6.73, while encouraging, should be taken with a grain of salt due to the limited coverage, but it does signal a professional perspective that the potential upside is significant. The ultimate takeaway from Autonomix's sudden jump is that a positive clinical readout, even from a retrospective analysis, holds immense power over a thinly traded, high-potential asset. It's a powerful reminder that when you are participating in online investing or using an individual brokerage like Robinhood for small speculative bets, the fundamentals of the underlying science matter just as much as market sentiment and momentum. The market is now officially aware of the profound quality of life benefits demonstrated by this technology. The expectation is now set much higher. The reality is that we are still a long way from commercialization, but the probability of achieving a meaningful clinical endpoint has arguably just increased. The narrative shifts from a risky bet on a long shot to a promising platform with early validation. It's an exciting day for the stock, but investors must monitor cash on hand and future financing activities very closely. Comment below. Given the high volatility and potential for future dilution, what maximum percentage of your total portfolio would you allocate to a